You've retired. The paycheck has stopped. Shouldn't taxes stop too? A lot of people get really confused about retirement income taxes. They think that maybe their tax will be significantly lower. And for a bit, that might be the case. But then they have to sell an investment to fund that once-in-a-lifetime trip. They get a tax bill. They have to pull money out of their IRA to buy their groceries and their gas. Tax bill. They start their Social Security and that paycheck and stability feels good. But there could be a tax bill. It feels like it might be a mistake, but in reality, it's just a bunch of taxable income sources all coming together and leaving you with a bill to pay. It's not the end of the world, but let's walk through what retirement income taxes there are and what you can do about it and what control you have to influence that. Let's start with Social Security. A lot of people think that Social Security is not taxable, and that could be true, or that could not. The IRS uses a semi-confusing formula to determine if it's taxable. They look at half of your Social Security, plus your other income, plus your tax-exempt income, and they compare it to thresholds based on your filing status. If you're below a threshold, cool, 0% is included in your tax bill. If you're in between thresholds, up to 50% of your Social Security can be taxable. And if you're above that threshold, up to 85% of your Social Security can be taxable. And this is taxed at what is called ordinary income rates, those same tax rates that apply to your salary or your wages throughout your working years. And that can feel like a lot. For many of our affluent retirees, 85% is that starting number because they already have IRA distributions and portfolio income. So it becomes a question of not how much is my Social Security taxed, but how much control do I have over the rest of my income? So let's talk about that. The next major piece of income is something called capital gains and dividends. If you have investments in a brokerage account, anytime you sell an investment or you just have income generated from those investments, it can be taxable. When you sell for a gain, that's called a capital gain. Depending on how long you've held it, it'll change the tax rate. If you hold it for 1 year or less, from when you bought it to when you sold it, then it's taxed at those same ordinary income rates. Again, a little higher. If you held it for more than a year, you get preferential rates, a little bit lower rates called capital gains rates, and they stack on top of your ordinary income. The same thing can happen for dividends too. When your stocks pay you a dividend, whether or not you reinvest them, that can be taxable as either ordinary or qualified. Now, it's nice when things are qualified, but that doesn't mean we should ignore their tax impact. When you sell an investment to buy a bigger house or purchase a car or go on a trip, all of these things can find their way to their tax return. Now, there's one important distinction. If any of these investments are held in your pre-tax account or an IRA, then they have what's called tax deferral status. Those investment changes don't find their way to their tax return. The tax event occurs when you take money out of those accounts and put it in your bank account. That is called a pre-tax distribution. And that leads us to another major form of retirement income. When you have saved diligently in your pre-tax 401ks or IRAs, it's a great thing. It's a great asset while you're working, but it can become a ticking time bomb when it comes to tax. As soon as you pull that money out, that money's landing on your tax return. And most people use those accounts for just their everyday life. But there's another aspect that comes later. It's called an RMD, a required minimum distribution. And then your distributions from your pre-tax accounts are no longer voluntary, they're mandatory. And people can lose control of their tax brackets really, really quickly. So an important distinction between that taxable and those pre-tax is you can control which investments are in which accounts. And that can help you be strategic about your tax efficiency based on which investments are in those accounts to reduce your tax picture over time. And lastly, Roth dollars. The only ones that will not find their way to your tax return. When you use a Roth IRA properly and you take money out of that account, you will not be subject to tax on that. Again, following IRS rules. However, a lot of people like to move money from their IRA to their Roth so they get that better tax status. That's called a conversion. When you do that, those dollars are taxable, and they're gonna add to that tax return just like all those other pieces we talked about. Now, all of these things, Social Security, IRA distributions, capital gains, dividends, these are all pieces of a holistic financial plan. If you are wondering, how this fits for your life and how to best fund what you're trying to do, let us help. We know that the questions on your mind and the questions on our mind are, how are we funding our lifestyle? What assets should be in which accounts? What taxes are we probably gonna owe this year, and what can we do about it? We're here to help, and we're here to help you live the life that you want to live, so you don't have to spend your time thinking about taxes. That's our job.